Bitcoin and cryptocurrencies like Ethereum are super sensitive to monetary policy. So I think that September 17th is an important catalyst. Crypto typically does really well in the fourth quarter. So I think Bitcoin can easily get to 200,000 before year end. I know it's a big move. It's almost a double, but that's also
almost
going to be
a double from here. Let's just hold on. Let's just take a quick pause. A double from here. So everybody's listening to this. We're at $111,000, and you think we, by Christmas time, effectively, we could be at 200,000?
That's right. One of the reasons Bitcoin stalled this year is...
Let's start with the Federal Reserve. According to Lee, the bond market has sent a clear signal after the latest jobs report. Fed fund futures jumped from pricing about 2.5 cuts this year to nearly 3. In other words, traders are betting the Fed will need to move more aggressively than it had previously communicated. Why? The answer lies in the balance between inflation and the labor market.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
We can see that Fed fund futures jumped from roughly 2.3 cuts by the end of this year to almost 3. So on the heels of that jobs report, the bond market essentially is saying that the labor market is now deviating further from the Fed's target than inflation, and therefore justifying actually one additional cut. So I think that makes sense to me, because we know inflation, and that August CPI gets reported this week, may be elevating, but that the markets are going to begin to view that as transitory. Whereas the weakness in the labor market, as you know, once it begins to weaken, it's very hard to reverse that momentum. So I think it's important for the Fed to intervene quickly.
And are you of the view 3 times this year, minimum?
Sense. To me, if I look at what the bond market's pricing, which is now essentially 3 cuts, and the Fed is talking about 2, the bond market is saying the Fed is behind in terms of how they're perceiving these changing conditions. And so I think on the 17th, when the FOMC makes its rate decision, I think there is a chance the Fed responds to that. And if it does, it's going to be good news, because the bond market is going to take comfort from the Fed recognizing the labor market's weakening.
Hey, Tom, even if the Fed cuts rates, it controls the short end, but not the long end. What do you anticipate happens on the longer end, and what do you think happens to the mortgage market, too, as a result?
The long end is something to wonder about, because we know globally, the 30-year especially has crept up. And we know that the Fed and other central banks have acknowledged that monetary policy has a lot of influence up until 5-year. You know, the correlation is 90%. But once you get into the 10-year, the bond market is making its own decisions about growth. That is something kind of troubling. But on the other hand, I think mortgage rates could come down sharply, because the spread between the 30-year mortgage and the 10-year is over 300 basis points. The 50-year average is around 160. So the Fed, if it begins to resume cutting and the bond market views that as essentially an easing trend, the 30-year mortgage could drop 150 basis points if the 10-year doesn't even move. That's a lot of easing for the housing market.
That is a big deal. And I know you're not an economist, but you have to have a view on where you think the economy is headed. If we get these Fed cuts and the economy, doesn't take a steep leg down, despite what we've seen with the jobs market, that's one thing. But if we get these cuts and you're also dealing with a slowing economy, potentially even a recession down the road, I mean, that's a completely different story. You looking at these Fed cuts as for good reasons, because we can do it and get away with it and it's going to improve the economy, or you looking at this and thinking, I worry about what comes on the other side?
I'm going to take the camp that I think that these cuts are actually going to be very constructive for the economy, because the 30-year mortgage is strangulating the economy. We know housing has slowed dramatically, but we also know that there's a lot of pent-up demand for housing. So it's a market that does need to be fixed in terms of easing sort of supply-demand conditions. And we also know that ISM, which is a measure of business confidence, has been below 50 for 31 months. It's the longest stretch since the ISM's ever been created. So I think business confidence recovers if the Fed starts to cut. And so the combination of easing mortgage rates, business confidence recovery, I think is kind of a broadening cycle. And actually, I think that's why small caps have been the second best performing group after Mag 7 over the last 8 weeks.
Tom, one of the things that Scott Besson said was he thinks that the economy is actually in better shape than we think, and that the jobs numbers are going to get better. How does that factor into your thinking, or does it?
I mean, I think on the margin, I'd agree with Treasury Secretary Besson's comments for two reasons. One, when we go through corporate earnings, we don't have any increase in comments from businesses saying business tapered off in July or August. So even though the labor market shows like it's deteriorated the last 2 months, business conditions haven't. In fact, even the Fed's beige book, most regions reported improving conditions. So that is one thing. And the second is we know the labor market undergoes a lot of revisions, and we get September's benchmark revisions. I think it may show that the job market's been weak all year. And in fact, maybe the last few months have actually been stable. So I think Treasury Secretary Besson is sort of correct to an extent.
Tom, Bitcoin, before we let you go, tell us what you think. We're at about $111,000. The upside, the downside from here?
Bitcoin and cryptocurrencies like Ethereum are super sensitive to monetary policy. So I think that September 17th is an important catalyst. Crypto typically does really well in the fourth quarter. So I think Bitcoin can easily get to 200,000 before year end. I know it's a big move. It's almost a double. But that's also going to be a
double from here. Let's just hold on. Let's just take a quick pause. A double from here. So everybody's listening to this. We're at $111,000, and you think by Christmas time, effectively, we could be at 200,000?
That's right. One of the reasons Bitcoin stalled this year is the Fed's been on pause for 9 months. That pause all year, if you look at an easing cycle, that's only happened 2 other times, in 1998 and 2024, where the Fed began to resume cuts in the fourth quarter in September. Equities do really well. As you know, crypto is beta to equity. So I think it's going to be a very strong fourth quarter. Small caps should also rally, like IWM, but that also is really bullish for Ethereum, which is highly linked to small caps.
Since the passage of the Genius Act just 2 months ago, billions of dollars are already being transacted through stablecoins. This regulatory clarity has unleashed pent-up demand, making it easier for institutions to use digital dollars for real-world payments. Lee notes that even in areas far removed from crypto, like commodities, stablecoins are increasingly being used to settle transactions. On NFTs, however, Lee is more skeptical. He views the initial hype around digital art and collectibles as a fad.
This is nascent stuff, a lot of it, and some of it really isn't tested in scale. That's what worries me. If somebody comes up with a strategy that involves a ton of leverage or has a new strategy in terms of wrapping, and it's worked for them with $25,000 worth of any asset, that's great. But what happens when you put $250 million to work? Is there enough liquidity at it from an institutional perspective? And so I look at it that way. And there's a pretty big community trying to figure this out. I would say the first scale occurring out of regulation in terms of large quantities of money is stablecoins. Since the Genius Act passed just a few months ago, you can actually see billions of dollars starting to be transacted. And that gives comfort to many people to see the liquidity, the transparency, the functionality working, and that it is compliant, that you actually can be compliant with regulators. Because usually the people that are doing this are involved in many other aspects of financial services, as I am. We can't afford to go offside in any way. And so there's a fair amount of hesitation on some of these new strategies because they haven't been tested at scale. It doesn't mean they won't work. It's just for the same reasons that people say, oh, Solana is the future for banking because it's fast. There's been a lot more transactions on ETH than Solana. So even though you might argue it's slower, it's kind of where, if you want to be conservative, and for me on ETH, it's really about using stablecoins to resolve payments. That's what we've chosen to do most of. And the payments are actually getting larger each month. We're finding more and more situations internationally in multi-geographies where a buyer-seller will use a stablecoin for the transaction. That is new. That certainly wasn't around for commodity purchases till recently. And so it's happening.
Are you surprised at how quickly it's happening?
I'm not surprised on stablecoin because it had been held back like a balloon underwater pending legislation. You know, there was that back and forth between the House and the Senate on the bill. I was involved in that. We weren't quite sure. You have to hand it to Senator Haggerty. He kind of helped drive it over the finish line. But that's behind us now. And so now that it's law, the balloon popped out of the ocean and boom, it's a fact everywhere. I mean, the last month, I'm amazed at how many transactions that we have done, even in the purchase of assets that have nothing to do with crypto at all. Nothing. They're not even crypto assets. They're old world commodities being resolved with stablecoins. I mean, NFTs are another description of going on chain. I'm only buying assets that are physical assets. They may be tokenized in terms of percentage ownership. NFTs turned out to be a fad. It doesn't mean putting assets on class or contracts on chain won't happen. They will. But that Kobe and the Jordan, those cards, they physically exist. They're in a vault. When you own a percentage of that, as I do, I own a physical asset, not something that was drawn pixels digitally. And so, this is just an opinion, but I won't be collecting NFTs. I'm collecting physical assets that could be tokenized for ownership claim through contract. That fad came and went. I'm very fortunate I didn't get involved in that because I never understood it. Where is the asset? Where can I put my white glove on and go touch it? That's what you can't do with an NFT. So, maybe I'm wrong, but I think really what NFTs proved is that you could put a contract in place and know where the ownership can be proven. And that in itself is very useful in the digitization of fractional ownership of a physical asset, a baseball card, a car, a watch, a painting. That makes sense. But in the end, people want the real thing. No, I don't see that working in terms of monetizing it. I think for those who want to see the legendary Kobe Jordan dual logo man with the golden, remember that logo man was on his body when he played in his rookie year on his jersey. That's the physical asset cut out of his jersey in that card, full authentication for rating, everything else. If you want to see it, you're just going to probably just go to a website where we'll show it to you, or something else I'm considering because the demand to see it has been so, you can't believe the number of DMs I'm getting on that card. I'm going to approach a few museums and find out who would like to put it on permanent display. There's so many fathers and sons that want to see it. I think we'll probably do that because I'm never selling that card. And so not during my lifetime. And so it should be in a museum. It should be where the hobbyists, it's a family tradition since the 50s. Fathers and sons trade cards. I can't believe how many closet collectors have reached out to me saying, look, is there any way we can bring my son's class to see this card somewhere? I mean, that's magic. So why shouldn't it be in a museum? That's the next discussion.
As a personal aside, Lee shares that he owns legendary sports memorabilia, like the Kobe Bryant rookie jersey card. For him, these items aren't investments to flip, but assets with deep cultural and emotional resonance. He even envisions loaning such items to museums where fathers and sons can share the experience of seeing them, continuing a tradition of collecting that spans generations. It's a reminder that while financial markets can often feel abstract, there's always a human side to value, trust, and ownership.